Is the stock market overvalued? Today I'm going to take a look at, is the stock market overvalued? We'll look at some historical data. We'll look at an example or two. And also we'll look at some other data to determine, is the stock market overvalued? This is July 2020, but the Dow's about 26,000. So if the Dow is over 24,000 or better, this video will still be relevant for you. This is some of the books that I read that focuses on valuations, psychology in the stock market. This was actually the 1970s, 1960 period there. Also, Devil Take the Hindmost. This is a great book, History of Financial Speculation. We'll look at the data. Once stocks become high, or once the P ratio exceeds a certain number, we're more into a speculation game as opposed to an investment game. So this is a key critical book there. And also this is one of my favorites. This is an easy read, Origins of the Crash. This takes a look at the tech bubble in 1999, the late 90s, that crash, a lot of the investors there. The current period that we're in, I would say with the technology, with the Robinhood apps, etc., that the technological aspects are similar to the late 90s in terms of the mania. A lot of young, inexperienced investors pretty much just gambling with stocks, picking stocks with no experience there. In terms of the inflation of this current period, I would say that we're in the 70s period when we had the big commodity boom. So it's a mixture of periods. Then when you add the coronavirus, I mean, that just has some multipliers, probably unprecedented times. Also, here's another random walk down Wall Street. That just has like general valuations, and it looks actually a lot at the PE ratios and is mainly investing based on that, or pretty much being able to pick stocks, general stocks in a regular period. So we'll jump right into the data. As I mentioned, Dow's about 26,000 as of this video. Here we have the S&P P ratio. This is probably my second most favorite chart or data that I use to determine a lot of the direction of the stock market. And it's basically the price of the S&P stocks divided by the earnings, which is PE, price divided by the earnings. And this ratio is similar to, you get a correlation. It's kind of like buying a house. Let's say you were buying a house to rent. House was $100,000, and that would be the price. The earnings would be the rent. Earnings, let's say you're making $10,000 a month in rent, profit. So that would be a PE ratio of 10. 100,000 divided by the 10,000, you're looking at a PE ratio of 10. The lower the PE ratio, the better, because in that 10 example, it basically specifies that you would get your money back or the P back in 10 years. So whatever that number is, that's the period or the number of years it takes for the return to be made. Similarly, if you're looking at rent, let's say you're charging $50,000 a month or a year for rent, $100,000 price, you're making your money back in every 2 years, which is a great return. Let's say the rent was $100,000 a year, price $100,000. I mean, that's a no-brainer investment. And as I mentioned in the book, that the lower that number is, the better, the more safe, secure, and that's given the fact that the earnings stay the same and they don't increase. And that's, if you believe they're going to increase, that's when you cross that thin barrier from investing into speculation gambling. So we'll look right at the data here. Currently we're at about 23. The average, the mean, we're looking at about 15. So we're way above average. And if you look at the periods, you have the 90s there. We're probably close to, you have 1985, but we may be in the third highest period ever. I'm not going to count 2008 because what happened there, the earnings were really about 1920 generally. But when you had the subprime, when that catastrophe occurred, you had a lot of companies, a lot of banks, financial institutions, they had a lot of that debt on their books, so they had to take a lot of take a lot of write-offs and write-downs, so that actually impacted their earnings negatively. That's where you see that explosion occur for the PE ratio. So right now we're about 23. You could just scroll down, look at the table just to see where we are historically. I guess the latest good period, was maybe 2012. Actually, 2009, some stocks were at 10 PE. Prior to that, we had to go back to 1983. And this is for really another video, but investing in stocks isn't always a thing to do. It may be a great move every 10 to 20 years, but that's the subject for another video. So we'll look at the subsequent returns based on these periods. So I'll go back to the chart data. Then we'll look at the I guess graph or information here. And this states what I pretty much just said. The lower the PE, the greater the annualized return. I mean, this is common sense or no-brainer investing if you ask me. And as you can see now, we're at 23. So subsequently, the next 10 years, we can expect about a 7% return, annual return. And much of that return, as I mentioned, we're in the 1970s inflation period. Much of that return will be eaten up by inflation and a devaluation of the dollar, because you have these epidemics with the COVID and such, that the U.S. has no way, much like the rest of the countries in the world, they have no way to exit the money printing. It's going to occur now with summer 2020. We're probably looking at summer 2021 in terms of financial incentives and money for the masses, basic income type of deals. So that's the PE ratio there. And I'll look at one or two periods. As I mentioned, we had a high period in 1999 here. We'll look at the subsequent returns. So here we are, and this is the Dow Jones 100-year chart. We'll just look to see how did the stock market perform. 10,000, it was 1999. 2007, 8 years later, went up about 30%. Ooh, that's not a great return. Then, what year did I say? 2 years later, after that, 2009, from the 10,000 in 1999, you're looking at about a 30% decrease. So you had your money in the stock market for about 10 years and stocks decreased 20%. So as I mentioned earlier, this was a horrible time to be an investor. And I think maybe 70 to 80% of stocks follow the general market. So the majority of stocks went down the same amount, if not more, give or take. But that's the Dow Jones. That's the PE ratio there. We'll look at an individual instance just to look at these crazy valuations. I mean, if you ask me. So this is Apple, and actually I'm an owner, or I was an owner of Apple. I bought in 2007 or 2006, one of those years, purchased all the way up until maybe 2013. But we'll look at the valuation now, 2020, compared to 2019, and we'll see what exactly changed. So I'll pull up the 1 year, or actually, I'll pull up the 5 year here. So we'll just find a low in 2019. What's the low? Here we are. So the low was about $150, 2019. Okay. And currently we're at about 380. So remember those numbers. I forgot them already. What did I say? 150 and 380. So what were the earnings then? Because now we have the prices. Let's look at the earnings. So we know now the earnings are about 12. So the PE ratio is 30. You take that 12, you divide it by the 12 into the 380, you get a PE ratio of about 30. And we'll look at last year's earnings to determine the growth as well. So last year, the earnings per share were $12.89, so about 12. This year, they're about 12. So the earnings haven't change much. And I can guarantee you most of this increase in earnings were due to buybacks. We're not going to get into the revenue and all of those things, but I guarantee you most of this increase was due to share buybacks. So you have pretty much 12 and 12, but you have a 150 price. I don't know what 12 divided by 150. What's that, about 12? So you had a 12 PE ratio last year. Same company. You have worse catalysts now, worse threats now. You have China trade wars, etc. You have COVID. People aren't buying phones. People aren't going out of the house. Same company. I can arguably say worse earnings. Revenue's probably lower. But we went from a 12 ratio, P ratio, to a 30. What's the justification for that? I can guarantee you the only justification, or the main justification, is the novices. They're being exploited by the media to get them to buy into. And that goes back to the book, Devil Takes the Hindmost. The devil is taking, or the evil, the corruption, the exploitation, they're taking all of those novices, the inexperienced, the ill-advised, misinformed. So based on Apple, valuation is sky high for no reason. It's just more than double from 12 to 30. If 30 is correct, what's that? Yeah, I guess it is, because that's about 360 plus a change. Whew, that's a horrible predicament. Then we'll look at the 10-year here, and this is just a 10-year treasury. And this is just a good benchmark in terms of other alternatives. And this is part of the problem. If you look at the 10-year rates, we're at maybe an all-time low here. So I mean, we're in the we're less than 1.6. We're at 0.62 here, 62 basis points here for the 10-year treasury. So there really aren't any other alternatives. So this is part of the reason why the stock market, or the money, is being pumped into the stock market. So that's the 10-year treasury here. This is a great chart here. This is the capital gains rate, because stock indexes, or stocks as a whole, they don't remain overvalued for a long time, because what happens is you get new presidencies. So right now we're in Trump. If the Democrats get in, you can see right now that capital gains tax, and this is, I think, probably back to 2010 or 2011, we're at, it's the lowest since the Great Depression. If you take a look at the political environment now, you can see that we're in a bunch of socialist types of agendas. Black Lives Matter, defund the police, give the money to the people, attack the corporate greed. So we're in a situation much like the 70s, socialist types of agendas. And you can see in the 70s that the capital gains tax, and this is the top tax rate, went from, 25 to 40%. So I wouldn't be surprised if Biden, the Democrats, get into office with the leftist agendas, and they increase not only the capital gains tax rates, which hurts investors, because now not only are stocks expensive, but you're being taxed more to take more risks. But also, you see here that this is, I think, one of Trump's analysts. It shows that Biden's progressive tax rates would result in the corporate tax rate increasing to 28% from the 21%. So that's another 7% increase in taxes that companies will have to pay. And also, as I just mentioned, capital gains tax jumping to, I guess is the top rate, jumping to 40% from 24%. So that's key. I mean, right now, it's kind of like picking up pennies in front of a steamroller if you're still in the market. It's really not worth it. Stock market, you can see the valuations are high. Also, one thing I did forget to mention about the valuations here, if you look at the table here, these are only estimates. So the problem is the PE is pretty much fixed, because we know Apple's, or the price, sorry about that, in the PE is pretty much fixed, because we know Apple is at the 380, but the earnings can decrease. And as you could expect with the COVID, a lot of companies, they can't properly forecast earnings. So we may be looking at a 2008 scenario where the price, Apple price, let's say, stays the same as 380, but the earnings, they're at 12 now. That's a 30p ratio. They decreased to 10, 380, 10. Now we're at a 38 PE, which makes returns even more ugly, even more negative. So let me know, what do you think? Is the stock market overvalued, undervalued? Are you buying stocks? Let me know in the comments below. Thanks for watching. To subscribe for more financial content, please click the circular button where the red arrow is located, and also watch one of the top 2 videos up top.